Friday, October 4th. I hope it's as pretty a day where you are as it is here in Colorado. This week the world moved under our feet. Interest rates began to decline 11 months ago and have just stair-stepped down in the most beautiful channel of descending tops and bottoms that we ever saw. And through that entire time, the driver has been weakness overseas, largely because of trade war, at least in theory. And the hope has been that that discomfort overseas would not infect the United States. And so we've been waiting and waiting and waiting to see if lousy data and falling rates overseas would translate into lousy data here and push rates even lower. And this week we got the first of that. But I need to be careful with that, what the hell that is. Two pieces of data were softer than they've been in 3 years. The Institute for Supply Management is the old Purchasing Managers Association. And in the last week of each month, it surveys its members to ask them how business is. And the surveys have worked very well to describe the current economy on the theory that purchasing managers are the first to know whether they've got more of what they thought they were going to have or less of what they thought they were going to have. But they're not recession numbers, they're just weaker. And the manufacturing one was weaker than the service sector one, but even the service sector survey slid for the first time. Does this mean we're going to go to recession? No, it doesn't. We got job data today, which the media latched onto as a poor report, and it's not. It's just ordinary. There's nothing really dangerous in it. But the mortgage rates are now under 4 again. The all-important 10-year Treasury note on Tuesday was 1.75, and today it's 1.52. Another marker is the 2-year Treasury note, which tends to predict what the Fed's going to do next. The 2-year on Tuesday was 1.66, and today was 1.40. So in just this week, the financial markets, whether they're right or wrong, have priced in an additional Fed rate cut. And they've also priced in a rate cut at the end of this month, which I would say a week ago the assumption was that the Fed would hold still at the end of October, and now the market's saying, they're going to cut. There's something fishy in this. That we also got U.S. trade statistics. Now they come in slowly, so the most recent month that we have data for is August, not September, as in these other data. But the trade picture, imports and exports, there's any change in it. Imports from China are slipping, but our total imports are just the same as they were, and our exports are better. So if there's contagion from overseas, where is it? I don't see it. This is heresy. I mean, the kind of thing that you shouldn't stand up in church and announce. But there's a better chance that the slowdown here and maybe even overseas, with the exception of the trade war aspect, which is clearly more harmful overseas, there's a chance that we're slowing down just because we're slowing down. The populations all over the world are aging. The inflation is low all over the world. Rates are low all over the world and not rising. So it may be an organic slowdown as opposed to an event overseas. There's a chance that we're slowing down just because we're slowing down. The populations all over the world are aging. The inflation is low all over the world. Rates are low all over the world and not rising. So it may be an organic slowdown as opposed to an event overseas. There's a chance that we're slowing down just because we're slowing down. The populations all over the world are aging. The inflation is low all over the world. Rates are low all over the world and not rising. So it may be an organic slowdown as opposed to an event overseas. There's a chance that we're slowing down just because we're slowing down. The populations all over the world are aging. The inflation is low all over the world. Rates are low all over the world and not rising. So it